Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
Credit unions, most of them, want more small business loans on their books. But few credit unions know how to speedily and profitably process small business loan applications. Consequently, most of those credit unions simply are lagging when it comes to booking business. Meet Alex McLeod, a serial startup entrepreneur who now is tackling the small business loan market with AI-powered software that her company, Parlay Financial, is now selling to credit unions. Her key message: succeeding in the small business marketplace requires the ability to offer fast, very fast verdicts on a loan app. Same day, preferably. And because many of these loans are small, machines have to carry a lot of the load. The rest of her message is that the technology to enable all of this is at hand. It's ready, it's workable, it's usable, and it's here. That's the game changer. That's the game changer that just may help many credit unions to finally succeed at small business lending. Heads up, the show begins with around 5 minutes where we learn Alex's journey to now and Parlay Financial. Most of these shows have similar chat at the beginning, but usually that chat winds up on the cutting room floor. Not this time. You'll know why when you hear her story. Listen up. The CU 2.0 podcast. Okay. I've never asked this question before, but I got to do this. How did you make the transition from singing in a band to having a fintech company?
Okay, so singing is a hobby and always has been a very passionate hobby of mine, but that is not my profession. So I've been in technology for about 10 years. This is my third company that's got a social impact focus. So I love building systems and software that help people do good things. But I also love music for fun in my spare time. So that's how I got into that.
So why are you in the US and not in the UK?
So my parents are English, and I was born in Hong Kong. And then I was raised in America and in France. So when I was studying for university in England, I started one of the companies that I ended up being on the founding team for. And that work actually led me to the US about 10 years ago.
And what was that company?
There were two companies. One was helping women in Haiti following the 2011 earthquake, helping them upskill into jobs in tech. We had a factory that assembled tablets and computers, and we trained women on the ground to be able to assemble those. And then we did a very similar concept in Buffalo, New York, of all places. But the government actually asked us to come do that. And we ended up taking a similar approach, different market, super different market, but we ended up building a social impact enterprise out of Buffalo, New York, in the high-tech manufacturing corridor up there. And we trained folks who were former entry-level manufacturing workforce, folks from super untraditional backgrounds, including formerly incarcerated people, including folks who were recently resettled in the US, including folks from areas of the city called Promised Neighborhoods, which is underserved areas, and giving them a similar track into high-tech manufacturing jobs.
Okay, so you've established you dream the impossible dream. Now that fintech, some years ago I wrote about fintech incubators, and one I wrote about was in upstate New York, I think in Buffalo.
Okay, is it 43 North?
I think so, and they had a heck of a lot of money available. You had to agree to spend, I don't know, a year or something in Buffalo. There were strings attached. You couldn't just take the money and move back to Manhattan. So.
That accelerator is still in existence. It's still up there doing its thing.
Oh, I thought it was one of the coolest
Uh,
accelerators. They actually had money that they were perfectly happy to throw around if you
yes,
offered something that sounded as though it would create employment in the great frozen north of New York.
that's right. So there a similar, a kind of sister program to the 43 North program called Startup New York. I actually think Startup New York funds were utilized for the 43 North accelerator. So we ended up coming in right about when they started that program. I actually think it was just a little bit ahead of it. But we were there for that reason, which was that Buffalo, New York was trying to create itself into this high-tech manufacturing and high-tech innovation corridor. And they've done pretty good. They've done really much better, I think, than some skeptics might have initially thought. So it's great people out there. I really love the people in Buffalo.
Now, this is an authenticity question.
Okay.
Do you know what beef on weck is?
I sure do. I love beef on weck.
What is it?
It's sliced beef that is put on a salted roll, and it is absolutely delicious.
And there are a lot of seeds on the roll too.
Yes, that's right. Caraway seeds, maybe.
I think, yeah.
Yeah,
But
delicious.
don't hold me to that. I'm not a great seed identifier. Yep. So let's talk about credit unions and loans. Now,
Let's do it.
most of the credit unions I talk to, and I mainly talk with larger ones, really, really want to get a small business loan operation going.
Yep.
And I talked to them a year later, and how's it going? Well, not very well. So, what are they doing wrong? Why so far, despite this avowal of serious interest, are
Mhm.
credit unions not making any headway in this? And as you know, Chase Manhattan has no interest in lending you $500,000. Zero.
Mhm.
Not
Mhm.
5 million. They'll talk to you.
Right.
I don't know if they'll give it to you, but they'll talk to you. 500,000 is, hey, that's pocket change. No, we don't do that kind of loan. We'll lose money on it. Whereas the credit unions want that market, they want that size, but they're not succeeding in many cases. Why?
Yeah, it's a great question. I think there's a lot to be said about how difficult small business lending truly is at the end of the day. I think a lot of people say, oh, it's pretty simple. Just ask some questions, put your forms, PDF your forms and send them out to the small business, and ta-da, you're done. But small business lending is very, very different from consumer lending. You can't compare two small businesses. It's like comparing apples and oranges. You could have two businesses with the exact same revenue numbers, but completely different business models, different industries, different risk profiles, different likelihood of repayments as a result of those things, and the different risk factors that go into it. So I think on the surface, a lot of organizations will say, oh, well, I want to get this loan program going. It's going to be simple. Let me do it. And as they get deeper into it, they realize how difficult it can be. And I want to add some nuance to that. Some of standing up a program can be simple, but getting small businesses to repay you is not simple, because of those different risk parameters, risk profiles, the way the business works, that seasonality and everything we talked about. So I think one, why it's difficult for these organizations is because fundamentally it is very difficult to start, scale, and then maintain a successful small business loan program. Secondly, and you put your finger on this when you mentioned Chase, is this one always surprises me, and I think it always surprises other people as well when they think about it. But I consider small business loans to be loans that are $1 million or less. It's the way the CRA defines it. There's a couple of other organizations that maintain that, $5 million in revenue or less a year is what makes a small business a small business. But fundamentally, if you're talking about small business lending, you are talking about a very small loan size, a ticket size that small business is going to be asking for. And I think that most financial institutions are not set up to be able to efficiently do that type of volume and that type of work. Because at the end of the day, I think it's 93% of small businesses are asking for $1 million or less in loans. More than 85% are asking for 250K or less. And then the numbers get super small, super quick, which means that if you're a lender trying to do those loans, you need really efficient, good processes in place, or the actual acts of underwriting and funding those loans is going to be very, very expensive. The loan economics are not going to make sense to do it. And then you're still trying to figure out how to quantify that risk on the other side too, and figure out whether that small business will repay you or not. So a lot of complexity has hindered credit unions and financial institutions from being able to do this efficiently at scale in a risk-adjusted way. But I do think that there's a new generation, a new category of systems that are coming in to help make that possible. And I truly believe that, and it's an exciting time as a result. It's not without its risks and without its considerations. Successful loan programs, it's not just technology that makes them work, it's people, process, and technology. But I do think we're going through a golden age of technology where suddenly things that were too risky, too expensive to do are becoming possible. And that's very exciting.
Well, if you think about the COVID era and small business lending,
Yep.
institutions like Wells Fargo actually issued a lot of loans and they were
Mhm.
very efficient at it. But I've always believed
Yes.
there was not a single human being who touched those applications at Wells.
Yeah.
It was all machine processed. Now, the
Right.
federal government was guaranteeing a lot of stuff. Hey, it's a different situation. But
Yes.
they proved that they can create a machine that can do small loans very efficiently. And
Yes.
now, as I say, the risk was probably the government was going to forgive most of them anyway,
Yep.
which mitigated a lot of the
That
risk.
helps a bit.
Yeah.
Yeah.
And so it's not an analogous situation. It just says a machine can do this. And one problem with small businesses is often their books are a little wonky.
Oh, yes. Oh, yes.
And it's often commingled with the owner's personal finances.
Yeah.
It's which makes it even wonkier. And
That's right.
I think, a guy at Chase or at Wells looks at this and says, get the hell out of here.
That's right.
Isn't there a regional bank down the street or a credit union? Go there, please.
Yeah. I mean, you're completely on the money, pun intended, with regards to how there is literally, I think, 200 or 300 problems that compound into the overall problem of small business lending. One of them is absolutely this data availability component that you're putting your finger on, which is that sometimes small businesses don't have their books in order. Sometimes they're not ready. Sometimes the data isn't accessible for a lender to be able to even weigh in on it, or a machine, right? In the case of very tech-forward organizations. And we often look at this problem of access to capital for small businesses and we say, oh, small businesses really struggle with access to capital, period. And the actual why of that question is about, as I said, 200 reasons, one of which is that data is very hard to access. Books are done all sorts of different ways. But I do think that's changing with the advent of different softwares, with the advent of different capabilities that allow both the small business, by the way, not just the lender, but both sides to be able to access data that is structured, that is clean, that is usable in a near real-time way. I think things are going to change and for the better. And there are already, as I said, this generation of systems that know how to orchestrate and pull in all of that data to be able to give small businesses answers. Not even a yes or a no in a loan approval or denial circumstance, but even are you ready yet? Is a loan even a good idea for you right now? Question mark. And I think that's pretty exciting in its own way.
Oh, that's actually exciting. Yeah, I know a guy who has a pretty brisk business making small business loans.
at very high interest rates. He's not organized crime. This is legitimate business,
Good
but
clarification.
very high interest rates.
Yep.
That much higher than a credit union could even legally charge. And all he looks at is cash flow over the last year or two. Depends upon how much money you want, but because he said they all lie or their books are bogus anyway. Let me just see the cash flow, and if I think they can service the loan, they'll get the loan. And the answer to that, he says, is cash flow. What do you say to that?
I think your friend, who is not in organized crime, has definitely put his finger on one method, a very efficient and effective method of assessing eligibility for loans, which is cash flow. Yes, it's not the only parameter. You find that I think leading practice lenders will look at cash flow, but they'll also look at a few additional things: the actual size of the loan request. So anything 100K and below, you could do purely on cash flow, and you could do them all day, every day. When the loan size goes up, so does the complexity or the kind of requirements that you need that small business to meet. But most small businesses are looking for a much smaller loan in size than lenders may realize. And so cash flow is something that allows instantaneous feedback, both for the lender to say, okay, yes, I do think that small business can service this, but also to the small business of, hey, I was able to connect my bank account, and within a minute, I was told whether I was a good fit or not a good fit for a loan, and I got an offer, and then I was able to do something about it. And I think historically, that type of lending was reserved to, as you said, the very high interest rate lenders, online lenders, even very large institutions. And more, we're seeing those community lenders realize that they have to be able to match that speed, that experience has to be something that they can provide too. Fundamentally, community lenders have been the backbone of lending to small businesses for hundreds of years. It is the thing that they pride themselves on, being this relationship lender, being that first call from the small business. But the expectations of small businesses have changed. It is no longer about just needing a relationship lender who can be there and be your counsel and your advisor. That's important. But speed, ease of use, accessibility of that loan matters more. And that's where you see, and you've seen it in the last few years, more and more small businesses just go to those simple, fast lenders who can give them a same day, maybe even same hour offer, answer. Loan could be funded and they could go back to work. And those old, less efficient methods that you see relationship lenders lean more on, those can't work moving forwards. And I think relationship lenders are having a moment of reckoning where they're realizing, yes, our secret sauce is to be this relationship lender, but that's not all I have to be anymore. And if I can provide that same speed, then I could deliver a better interest rate to that small business, and they're likely to stay with me instead of going to an online lender, somebody else who can provide that high interest rate alternative. And now you're giving small businesses better tools, better solutions to the problems that they're facing in their day-to-day.
Well, I think you touched on something important regarding small business loans. A Fortune 500 company knows what it's going to need to borrow next year and probably the year after that.
Yep.
When that small business guy comes into your office or woman comes into your office, they want to walk out with the money in their pocket. They need it.
Yes.
This is not like a long distance forecast. It's like the wolf is at the door, or there's a great opportunity that takes some cash to capitalize on.
Absolutely.
They want a decision today. And as you say, preferably right now, yes or no. Now, so how does your company come into this, and how do you help deliver right now answers?
Yeah. So what we do, the company that I'm the founder of is called Parlay Finance. What we do is we have a software that we sell to banks and to credit unions. They can use it in a white label capacity, so they can stand it up with their own branding and all of that. and push it out to their small business loan applicants. That could be a net new customer, or it could be an existing customer. What Parlay does is we're an intelligent intake system, which means that we use artificial intelligence, AI, to help deliver a really, really good, rapid experience for that small business that is ultimately applying for a loan with that lender. And so our software is a type of software called a loan intelligence system. And it means that we can rapidly intake information from a small business, very, very quickly understand the eligibility of that small business for the different loan products that that lender can offer, and get them answers much faster than the average lender could provide if they were doing things in a manual way. And so there are two very important parameters to that. One is how we gather data. So you were correct. A small business wants to come in and get a yes as quickly as possible. But to do that, they need to be able to have their information at hand and ready to go. And so our system helps do that. We gather and orchestrate the information that a small business needs to be able to provide. We ask the small business very simple, intuitive questions that they can get through very quickly. And then for the lender, what we then do is we validate all of that information. We run it against the universe of loan products that lender can offer. And then we surface a recommendation to the lender on what is the optimal product for that small business so that they can get them a yes. And all of that to say, we're trying to make it faster and easier in a risk-adjusted way for lenders that are that community lender to get that small business to a yes as quickly as possible. And so that's the mission, and that's what we do.
And how is this priced?
Yeah, so we do two things. Our platform has two variable components. So the number of small business applicants that are going to come through the system in a given month is one component, and then the number of lenders that are going to use it on the other side is another component. But it wraps up into an annual SaaS fee. And two of the benefits that we've seen lenders get really excited about is, one, we make the entire loan program 10x more efficient. I'm not joking. I find that number amazing as well. But when you cut out 90% of the manual work that a lender has to do, that lender can do a lot more loans in a way that allows them to serve a lot more members, in the credit union universe than they could before. So one is efficiency, and then the other is an increase in actual revenue that can be booked. So every small business loan applicant is a potential customer or an existing customer that you can serve and you can help long term. So the loan is that first interaction, maybe, where they're requesting a loan from the credit union, but they might also need other products. And so at that point of application, because our system is gathering a lot of information, we can also identify what other products might make sense to help that small business grow. And so that allows the credit union to do some cross-selling, some upselling to help that small business with their needs, but to do so with much better data than before. And the last thing I'll add is, this goes back to the very beginning of our conversation, but social impact is really, really important to me personally, but also to our business. It's our mission. Most small businesses that are applying for a loan do not get a yes. They apply and they get a no. And that is pretty devastating when you're a small business and you think that the world is going to end if you can't get that loan right now. And so one of the core capabilities that we have in our platform is we help small businesses understand what it takes to get to a yes. And so instead of just applying in a vacuum, sort of like taking a pop quiz without the answers or knowing how you're being scored, we actually help small businesses understand the parameters that they're being evaluated against and which ones they should prioritize moving forwards if they're not going to get a yes, so that they can get a yes in the future. And that allows, one, the small business to understand a lot more about what's going on than they do normally, but it also allows the lender to then remain in contact and build trust with that member over time and be that relationship lender that they want to be in a way that is helpful and beneficial to both sides.
Now, what size credit union do you see as the target market?
Community lenders, generally, we see anything 10 billion and below is a real sweet spot for us. We seem to have a really, really strong fit with credit unions between $1 and $5 billion in assets. I think it's because these are organizations that are pretty agile, but also able to lean in on the digitization side, on the digital sort of growth side, and say, okay, I'm trying to grow my credit union, and I can't do that without really good technology in place to enable that efficient data-driven growth. And so we're really seeing a sweet spot in that space. And that is especially the case right now as interest rates have been dropping. Small business is back on the priority list in a really exciting way. And I think that 1 to 5 billion spot is where credit unions can really lean in and try things that are innovative. I've seen smaller credit unions get excited as well, larger ones, but again, that 1 to 5 seems to be the sweet spot for us right now.
Well, a credit union that size, most of them are big enough so they have some semi-sophisticated understanding of what they suck at. And and
love it. Yes.
I'm not saying they're going to write a letter on their website saying we really suck at these things. No, they're not that honest. But in a private conversation, they'll admit that we're not so good at this or this or this.
Yes, I think that's a great insight.
And many of them are struggling with small business lending. They all want to do it, or all the ones I've talked to want to do it.
Yep.
Most of them are unhappy with the results. Some of them have gone out and bought community banks to
yes,
or other operations to get the damn small business lending operation, and they're still not happy with the results.
Yeah, and there's so much trapped capacity in the credit union ecosystem too. I've had some conversations with folks who say, "Oh yeah, we have all these different consumer products for our members, but we're aware that we have several thousand members who are also small businesses, and currently we don't have anything to help them." And they see intelligent systems, right, loan intelligence systems, as the types of products that can help them deliver that capability in a way that can meet the needs of those members who are both individuals but also happen to be business owners too.
Now, is your product, I'm going into tall technical weeds and probably will get lost, but that's all right. I've gotten lost before. Your product is not generative AI, it's extractive AI, right?
We use a mix. So we have different types of AI for different types of problems. So I will not get on my soapbox for too long, but I will say quite quickly in the beginning, sometimes people think about AI and they assume that it means generative AI.
It's ChatGPT. It's not just generative. No, it's Google's Gemini is a lovely product.
Yes, exactly.
I use it. I never use ChatGPT, and I'm not being paid by Larry Page. I wish I were.
That would be awesome. Yes. Well, exactly to your point, right? People just assume that we mean ChatGPT and thus Gen AI. And inside our product, we have different kinds of AI to help lenders solve different kinds of solutions. So to give you an example, there is a capability we have that can rapidly summarize different pieces of information. And in that case, using Gen AI makes sense, right? You're asking it to summarize data points, not generate any, right? We have many safeguards to make sure that doesn't happen, but there's lots and lots and lots of different places in the loan origination workflow or stream where there are inefficiencies without tech like ours. And so for every one of those inefficiencies, we have different tools to solve them. So for the inefficiency that is manually writing a summary, yes, we can generate a summary of a loan inquiry and whether it does or doesn't fit the parameters that that lender has outlined in their credit box or in their credit policy. But we also have a couple of other types. So, one of the ones I'm actually most passionate about is a type of machine learning. We use a classification algorithm that basically helps at the beginning of the process identify what product would be a good fit for the small business. And we did that because oftentimes, you pointed out that 1 to 5 billion size, they tend to be aware of what isn't working, which is, by the way, a huge strength. And I love that. Oftentimes, if you go to the website of a given credit union, maybe in that space, you'll find that there are 10, 15, 20 different options that a small business could go click on, right? Hey, interested in a working capital loan? Click here. Interested in SBA? Interested in this and that? And generally speaking, at least when we've talked to small businesses, this is the feedback they've told us. A small business doesn't know what they need in terms of the loan product. They just know that they need money, and they know that they need a loan as quickly as possible, as efficiently as possible, etc. And so one of the core things that we did inside our platform was decide, okay, well, if it's so difficult for the small business to navigate those experiences, why not just make it like a common app experience instead? If you remember, back in the day, every university had their own application experience, and it asked different questions, and it was unique, and it took all this time. And then the Common App changed that and made it more streamlined and more efficient. We've taken the Common App experience and basically brought it into the credit union loan application experience, where you're always just going to go through one flow. And on the other side, our system is going to also detect what is the right product for you that lender has. And this is really helpful for the small business because they don't have to guess. And it's really helpful for the lender because sometimes, the SBA team is going to receive an application that's not good for SBA. And maybe they'll do a good handoff to another department. Maybe they won't. Maybe there's going to be a drop-off where actually Robert applied for a loan that he wasn't good for, but there was another product at the credit union he was good for, and somebody forgot to forward it, right? So it's the different problems need different solutions to address them. So we have different methodologies inside our system to help solve these different types of problems that lenders run into in that day-to-day process.
Now, what's to stop a Chase or go down a notch, a U.S. bank, from reaching in their pocket, pooling their lunch money, and buying a company like yours or a competitor, and saying, "Hey, we're gonna mechanize AI-driven small business loans. We know we haven't been real cooperative in the past, but we love you now. We got this little machine. We love you. Come on in." What's to stop them from doing that?
I personally would be very happy if more institutions invested in helping more small businesses. It is a massive, massive market. The CFPB estimated that small business lending was a $1.7 trillion market. And I think that right now the systems are very inefficient and don't serve small businesses, but even the efficient ones are only looking at this in a very binary way, in a very either you're eligible or you're not way. And so what we're missing out on is that entire universe of small businesses who aren't eligible right now, but could be soon, or who aren't eligible right now for a specific product, but are in another universe, loan product, credit policy requirement. And so nothing prevents most lenders from trying to build their own thing or buy something different. But it's much harder than you think to replicate that kind of stuff. I think often about YouTube back in the day. They were trying to sell their capabilities to a prospective customer. Said prospective customer asked the internal team what they thought, and the internal development team said, "Oh, we have that on the roadmap. We're going to take care of that. We don't need YouTube." And YouTube became the global leader, a juggernaut. There's no lack of institutions trying to solve this problem. And my question to them is, why hasn't it been solved yet? I think the way in which these systems have been developed is one of the reasons. If you're just solving for a binary outcome, then you've excluded 90% of the universe that is attainable there. That's one piece. But two, our system ingests data and outputs insights that are different and unique. And as we do that, we build data that credit unions can leverage to generate insights and competitive advantages that no one else has. And I think that until everyone thinks long and hard about where they get their data from and how they build that into a data strategy that enables them to compete with the giant lenders, the Chases of the world, others are going to win and they're going to be left behind. So one, I mean, obviously we want to work with as many credit unions as we can to help as many small businesses as we can. Lots of players in the space trying to make XYZ thing incrementally more efficient. And I think there's a bit of a reckoning going on where lenders are realizing, hey, we need a quantum leap in how we do things. And the technology has finally caught up. And it's a really exciting time.
What's involved in a credit union becoming active with your loan intelligence system? I mean, how long does this process take and what's involved in it?
So it's a fantastic question. I'm going to give you a consulting answer, which sucks, but it really depends. So to stand up a loan intelligence system, in my experience, and this is a requirement that I think lenders should be entitled to. Like, our product can be set up in 1 hour. It can be set up in 1 hour with a universe, seemingly endless universe of different loan products that could be put into it. One of the ways that we built this was so that lenders didn't have to wait 12 to 18 months for a product to be live, which is currently how a lot of legacy systems end up getting implemented. So the credit union will sign a contract, implementation will begin, and 1 year later, they're still not done. And that's extremely frustrating for them. One, because they made an investment that, currently the ROI still isn't there. So now it's just a cost and there's no ROI coming out of it. But two, the longer they wait, the longer they're waiting to get that data that ultimately is going to enable them to compete in the market. So one of our core capabilities is that we can stand up our product same day. Now, to connect it into the tech stack of the lender, that sometimes depends on the tech stack itself. So different lenders have very good digital forward stacks where we can very easily plug into a loan origination system, a digital banking system, whatever it is. And sometimes they have a sort of Jenga stack of legacy systems that don't talk very well to each other, that take time to connect to things. Sometimes the vendors themselves are not very open to collaborating. And so it really depends on what the tech stack looks like on the other side. But standalone, we can deploy it in 1 hour. If we have to connect it in, assuming that it's not that Jenga stack, probably 6 weeks end to end to get it live. If it is a Jenga stack and there's limited resources on the credit union side to assist us with connecting that up, it might take a bit longer. But gone are the days where credit unions should have to wait a year and a half to get their systems up and running. And I'm excited to help them lean into the next era of tech in that way.
And what's your financing?
Yeah, so Parlay is venture backed. We have gone through a couple of amazing programs. We have phenomenal venture backers, including venture funds like Fenway Summer, Alumni Ventures, Capacity Capital. We did a couple rounds last year and the year before. We're closing one up now as well. So short term, primarily venture capital. Over time, the goal is to achieve profitability and continue helping as many credit unions as we can.
What's your exit strategy?
I think there are different options. So I'll outline the common ones I've seen, at least in the market. Very often, you'll find that fintechs or kind of bank tech solutions that serve credit unions and banks will end up being acquired by some form of strategic acquirer. I think that's probably the path that most people look at in the space. I think it makes sense if there's a lot of synergies on the table where suddenly, you can partner with a larger institution that can give you expanded data and reach to help more and more customers in the market. The other two sort of paths that you'll see are going public, which is definitely on the table as well, or some form of PE backer or acquisition down the line. So I would say for now, all pathways are open. Parlay is extremely partnership driven. So for us, our growth and how we scale and go to market and add value to credit unions is through partnering with, their vendors on the tech stack legacy side, through distribution partners that include, credit cards. We have a partnership with MasterCard, for example, and there's a couple of other ways that we can really add value in a way that isn't just incremental. Yeah, long term, we'll continue to remain partnership focused in that way.
Have you looked at setting up a QZO, credit union service organization?
Yeah, we've definitely been approached about becoming a QSO, and I think I'd actually love your take on QSOs generally. I think it is a really novel and cool idea to be able to pool resources together in that way. Curious on your take on sort of the long-term efficacy or maybe the pros and cons of going the QSO route.
Well, what a number of companies do is they set up a separate company that's a QZO. And because you have your venture-backed company, okay, fine, you can't wrap that up very conveniently. But you set up this second one that's a QZO that's owned by credit unions and only serves credit unions. And it's neat, clean. Look up Prize Out. That's one word.
Prize Out?
Prize Out, Prizeout. And they are venture backed. They had a lot of money, but their CEO set up a QZO that's very successful. They have some of the biggest credit unions in America that are members of the QZO. And
amazing.
I asked him, had you heard about QZOs before you got interested in starting one? He said no. And I said, good. I wrote about credit unions for like 5 years and I had no clue what a QZO was.
That's too funny.
But
it's great.
It's an interesting financing mechanism.
It is.
And you don't have to wrap up your venture-backed company to become a QZO. It's a separate company. It's kind of cool.
That is.
I mean, anything could come out of the woodwork, and you'll do okay.
Well, I loved the questions, first of all, and I think if I was going to leave credit unions with one takeaway, and I say this as a person who's a pragmatic user of tech and builder of tech, I do not think that tech is a silver bullet that's going to solve everything, and the latest iteration of that is with AI, where everyone puts their hands up and goes, "Oh, Gen AI will solve it all." I do actually think that we're in a golden age of technology where what previously was completely unattainable, right? An instantaneous assessment of a small business's eligibility and a hyper customized, personalized offer lands directly in front of them in a way that perfectly meets their needs. That is now reality. It is possible. It is here. And you don't need to add a ton of headcount to 10x the things that you do. And sometimes I find that when I talk to credit unions and I show them the stuff that our system can do, other loan intelligence systems can do, they are taken aback because it is such a big jump forwards. And, when I think about strategic tech forward credit unions that really want to radically change how well they can meet the needs of their small business members, the tech has arrived. And that is the most exciting thing. It's not possible without mindset changes and without the right people on board. I don't think we're ever going to replace human judgment in this, but suddenly it's like having relationship lenders on steroids in your pocket. And suddenly you're going not just incrementally better, but 10x better. And that gets me excited. So I guess my takeaway for the lenders out there is what we once thought was impossible is actually completely, concretely feasible right now.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey. Again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.